Okay, well, perhaps we'll begin. So, good morning, everyone. Thank you for joining us today. I'm Graham Handy. I'm the leader for our insurance advisory businesses at BDO. I'm an actuarial partner, and I'm joined today by a wealth of colleagues from across the insurance team. So first of all, we've got Geeta, Joshi. Geeta's an insurance external audit partner. We've got Santiago, Restrepo. Santi's an actuarial partner. We've got Nicola. Nicola leads our governance, risk and conduct teams for insurance. And then we're also joined by Thomas Toe, Claire Murray, and Ravi Prajapati. Thomas leads our insurance tax team. Claire and Ravi both advise extensively in tax matters across the industry. Before we get going, I'll just touch on the usual housekeeping points. So we will be recording today's webinar. We'll circulate the slides to you all afterwards and the recording in a few days' time. Your lines will automatically be muted throughout the session. If you have any questions or observations, please do submit those to the panel through the session using the Q&A function, the button at the bottom of the screen. So before we get into the deep detail, perhaps I'll just share some observations on what I see happening across the market at the moment, whether you're in retail, general insurance, commercial lines, or the specialty markets. We're going to dive deeper into a few of those areas on this call, but for a moment, let's just take a look across the big themes that seem to be at the forefront of many of our clients' minds. And I should say these are personal observations rather than being official BDO conclusions. So first of all, we've got climate change considerations that have featured in the media commentary for quite a long time now. But I think what I'm observing is that the industry is starting to be well grounded in the key elements of the scale of the risk that climate change poses to our industry. The tools to mitigate those risks are less well understood, and there are plenty of scenarios that we've all considered that materially attack our firm's strategic positions. So it's right that boards are keeping climate change firmly on the agenda on an ongoing basis. It should be, if it isn't already, a key part of any of your capital planning, your risk appetite considerations, and your setting of objectives for the coming years. And it should be a regular part of your dialogues with analysts, with shareholders, and with other stakeholders. On top of that, of course, many of you are already disclosing your positions through TCFD reporting. We're starting to see that TCFD reporting settle into a better rhythm now. And in fact, those of us who are perhaps less developed in our reporting rhythms can learn quite a lot from the early disclosures that some of the more advanced players have already put out there. Those who have been through 2 or 3 rounds of TCFD reporting are now able to really focus on the improved big picture thinking, improving the data sources and refinements. Secondly, we've got macroeconomic uncertainty, and that we can all see a fundamental level of fragility in the system, and it's not showing many signs at all of reducing in the short term. We are seeing a direct impact on capital appetites, on buying and acquisition decisions. Higher hurdle rates are being set for risk. Most players in most industries, not just insurance, are slower to invest at present. And I think this is all just symptomatic of a phase change that we're going through. 15 plus years of low interest rates, and now a very rapid phase change to materially higher interest rates. Those phase changes are always painful. Many of us haven't operated through high inflation, high yield eras before. So far, I think demand for insurance product is holding up on balance, whether that's because it's a grudge purchase or actually because there's a real sense of the value that risk protection brings. But pressure is coming now from regulators and from governments to keep retail pricing affordable. There's a sharp focus now on vulnerability and vulnerable customers. And it makes me wonder, again, maybe more for retail than for commercial, it makes me wonder whether the ultimate margins we expect to be making on the products we sell today may well be diluted as things like premium holidays, claim reviews, compliance costs start to get baked in. Then we've got new value propositions, partly in response to this, sort of this challenging environment that our customers and clients find themselves in. In the retail space, we're seeing signs of increased agility in the products that are coming to market, more of an option for the client or customer to blend between genuinely mandatory purchases versus the voluntary aspects of risk management they choose to pay for. With the cost of living crisis, it's a sensible defensive move on the part of any insurer to provide some flexibility to customers, and the digital, the data, the innovative space that some of the tech companies are now offering insurers to play allows us to do more of that. I think that's going to continue to increase, and the consumer duty reinforces still further some of those some of the priority for those changes. We're going to hear more about consumer duty shortly. Penultimately, we've got stakeholder interpretations of IFRS 17 to come. But the full IFRS 17 disclosures do have potential to create quite a lot of noise over the coming quarters as analysts just try to achieve some kind of comparability across organizations. And again, we'll hear from Geeta on that very shortly. The final thing I just wanted to draw out was some of the things which are touching the banks, the asset managers, that may well start to touch the insurance industry. So we've been seeing the opening up of the banking world with open banking, open finance, and the mandatory open APIs that force the banks to share consumer data back to a wider set of the consumers' service providers. There's no mandatory requirement yet on insurers for something similar, but it's worth keeping a very close eye on that because it may well come. And finally, the other FS dynamic that we observe is the shift perhaps away from it being just the banks who bear the brunt of fraudulent activity, and a strong onus now coming on other parties, particularly the tech firms, to put their hands in their pockets when fraud happens. Now, insurance is an industry full of companies with perceived deep pockets. So again, we should keep an eye on that, and the potential for more fraud costs to fall on the insurance industry would obviously not be a pleasant thing for us. So that's the big picture, a bit speculative, but there's a lot of moving parts at the moment. And against that, then we have some very detailed moving parts, which BDO would like to take you through in the next short while. So perhaps maybe first I'll hand over to Santi to give an actuarial perspective on things.
All right. Thank you, Graham, for that introduction. Ladies and gentlemen, thank you for joining me today as we explore some of the most pressing topics in the world of actuarial and risk management. So it is safe to say that the realm of risk management is ever evolving, and there is never a dull year. Today, I'll touch upon a few significant themes introduced by Graham, while also shed light on some additional others. So first and foremost, let's address the elephant in the room, which is climate change. The PRA set out its expectations for climate risk management 3 years ago now, And since then, mandatory TCFD reporting has been introduced in the UK. The amount of information and documentation on climate risk management and governance seems never ending. However, amidst the Solvency II reforms, there is still a lack of clarity regarding the implications for the solvency capital regime. So we must be cautious, though, that as the lack of clarity does not necessarily mean that there will not be capital consequences. So regulators have indicated that they can impose additional capital add-ons on companies with weak climate risk management or governance. The Bank of England's latest report on climate-related risks and regulatory capital frameworks has noticed significant disparities in the level of climate risk integration within risk frameworks across the industry. And as a consequence of that, they expressed some concern that the industry as a whole is ill prepared to effectively control and mitigate climate risks. So where does this lead us? Currently, the challenge lies in simply incorporating climate risks into our existing risk management and governance frameworks. We need to bridge the gap, or what the PRA terms the capability gap, by improving our ability to do simple risk management, identify, measure, and manage climate risk. But in this area, there are three main challenges remaining. So firstly, data availability remains a hurdle. We require appropriate data on carbon emissions associated with investments and insured assets. While some solutions exist and are emerging out there, we still lack standardized, globally comparable climate disclosures. Secondly, uncertainty persists in taxonomies, and how do we go about classifying assets regarding the sustainability of them? So for a company starting now in their measurement and therefore management of climate risk, then the winning strategy here would be to develop a system that can easily adapt to changing taxonomies until consensus is reached. Lastly, and the third main hurdle is that there is a time horizon gap. Our risk management and capital frameworks typically consider time horizons that are much shorter than those over which climate change and transition risks materialize. So this applies to both the quantitative aspects of risk management as the qualitative ones. So one of the critical challenges we face is understanding how climate links to existing risks. The most obvious one here is natural catastrophe risk. So as we all know, climate models are different to weather models. And weather models is what we use to model our catastrophe risk over the 1 or 2, 3 year time horizon that we're used to. But however, there's still lack of scientific understanding of how long-term climate models convert into 1 or 2, 3 year time horizon weather models. Moreover, the actions that governments take now can alter the nature of companies' physical risk exposures moving forward. So this basically means that it makes cat exposure itself a moving and unpredictable target over the time horizons that we're now required to think, which are 15 to 30 years. So when it comes to the regulatory landscape, discussions are underway about potential macroprudential climate systemic buffers. That's just talk at the moment. But for now, regulators have indicated that they're still evaluating the need for reviewing capital charges in light of climate change. But their inclination is to say that perhaps for now, they don't need to change. Nevertheless, an entity does still bear responsibility for identifying the likely impact on their solvency and determining any additional capital needed to meet the challenges posed by climate change via their own risk and solvency assessment. So now then, moving on to economic and political uncertainty. So predicting the future is no easy task. The economic and political climate remains very uncertain, as Graham touched upon on the introduction. And this has been a persistent topic for a few years now. Now, for instance, the ongoing conflict in Ukraine will definitely continue to pose some threats to the economy and probably directly on claims. And the economic situation in the UK is likely to remain subdued for the foreseeable As always, when this is the case, there is pressure to reduce costs and increase efficiencies, and more so with inflation likely to stay with us for a while. Although, as a hot topic, the novelty of inflation hitting claims has worn off a bit. That was the hot topic probably towards the end of last year. Supply chain issues increasing some claim costs. They should sort themselves out as the world emerges from the COVID disruption. However, some skill shortages still persist, and we're even starting to feel those skill shortages in the realm of actuarial and risk management. And finally, to say, with the upcoming election in the UK, there is a higher likelihood of regime change at the moment, so potentially leading to shifts in regulation. And what comes to mind here is the current review of Solvency II and the consultation, which is due to end later this year, where any implementation of any of the changes may be influenced by the policies of the new government. Now let's shift focus to an area where companies do have more direct influence. So I'm here talking about portfolio management in more on this specialty and commercial line space. So as we anticipate the softening of the underwriting cycle over the coming years, portfolio management becomes critical in supporting tactical underwriting actions. And this is to strike the right risk-reward balance in the book as a whole. So good portfolio management starts with effective exposure management, where we gather information about exposures and potential losses. Now, exposure management is another such of those hot topics, but it's very clearly linked with portfolio management. So recently, we've heard from the regulators the wish for them for companies to get grips on the man-made catastrophes and casualty exposure management, and this is part of the puzzle of portfolio management. Now, but portfolio management goes one step further than simple exposure management and asks, are we receiving the appropriate level of premium for these exposures? Now, the management in portfolio management then consists of using this insight to increase the volume of exposure in those areas where the risk is appropriately rewarded and reduce it where it isn't. Now, unfortunately, this sort of analysis is often conducted at a very macro level during the planning stage, if at all. And to achieve robust portfolio management, companies require excellent analytical capabilities and access to quality data to take this analysis to a more granular level that will allow them to do those tactical underwriting decisions. Now, this brings me to the topic of analytics quite neatly. So when I refer to analytics here, I'm encompassing the broad use of IT tools to convert data into actionable information. Now, many believe that analytics only thrives with extensive numerical data, but that may not be necessarily true. So even within insurance companies, there is a wealth of untapped text data that can be converted into insight. For instance, claims system information can be leveraged to enhance claims databases or to enrich them using robotic processes that extract key themes from claim narratives within the claim files. And this can be achieved using natural language processing algorithms in tandem with the robotic processes. This allows us to quickly analyze thousands of claims and identify patterns. And it can also allow you to identify outliers, that is, things that you did not know were there in your unsettled claims. Similarly, natural language processing systems can ingest underwriting information. This is the underwriting submissions, which are generally in the form of presentations and lots of text. And by analyzing this, the system can provide a comprehensive landscape of what your live exposure is. And this goes beyond basic classification, and it enables us to extract valuable insights about companies, industries, jurisdictions, and potential issues arising when it's cross-examined against your claims data. A simple application for this would be in cyber, which is another of the hot topics at the moment. So we know that when assessing our exposure to silent or affirmative cyber, the key element to consider is the exact wording on the slip. So there are many wordings, and these could react differently to potential scenarios. If the underwriters did not capture the exact wording at the underwriting stage, which is what is the case in most companies, this information is seemingly out of reach for use in analytics. However, by using robotics and NLP techniques, you can scan the entire book and know exactly which policies use which wordings. Now, these steps are the foundations for good portfolio management. Now, furthermore, in the context of climate risk, having robust analytics is crucial for closing the capability gap. Right? Mastering the identification, measurement, and management of climate risk requires a deep understanding of each asset and the insured's potential exposure to emission. And analytics can play a key role here in integrating your systems with externally provided data, etc. So being clever about analytics will help you get those quantitative measures that will form the basis of your climate risk management. Now, let's not forget the role of analytics in financial transformations and reserving transformations, because these endeavors are basically aimed to swiftly and efficiently convert raw data into valuable information for decision making. So efficiency in our work process is paramount, especially given the shortage of skilled actuaries and risk managers and the pressure to reduce costs given the economic circumstances. So analytics plays a significant role in meeting the challenge of reducing costs and becoming more efficient by streamlining operations and enabling us to make data-driven decisions. Now, in conclusion, the actuarial and risk management landscape is continuously evolving. As professionals in the field, we must remain vigilant and proactive in addressing key issues. Climate change, economic and political uncertainty, portfolio management, and analytics are just a few of the many facets we must navigate. As the picture in the slide shows, analytics could prove to be a key ally in dealing with the hot topics on the left. For instance, the challenge of climate change capability gap is made easier once you have good processes underpinning your quantitative reporting. Transforming inefficient processes can help you reduce the cost of inefficient processes, and data enrichment can help you unlock insights via the application of portfolio management, in turn helping you ride out the underwriting cycle and manage your exposures effectively. By incorporating climate risks into our risk management frameworks, harnessing the power of analytics, and adaptively managing our portfolios, we can navigate the challenges ahead and seize opportunities for growth and success. So with this, I come to an end. Thank you for your attention. I now invite Geeta to continue the discussion.
Thanks, Santi. So I'm Geeta Joshi. I'm insurance partner in BDO. Today I'll be talking about IFRS 17, mainly covering three elements. One on IS 8 disclosures, stakeholder interpretation reflecting KPIs, and what should be done next, right? So IFRS 17 is already effective from 1st Jan 2023. As we see, there is significant impact on life insurers as compared to non-life insurers. Small insurers have actually trying to put speed into their preparation for IFRS 17 because they have been waiting sort of to see large insurers by making them set the tone on the top and also by seeing the rounds they are making in terms of investor story sessions and IS 8 disclosures in the 2022 financial statements. So now when we look at IS 8 disclosures in 2022 financial statements, we are seeing various disclosures. Some insurers have really restated their opening balance sheet. Some have only shown the net impact on equity, and some have tried to show the range in terms of impact on equity amount. There are also companies who have not disclosed anything on quantitative, but have actually only shown qualitative accounting policy impact. So differences in terms of how the disclosures have been made. Now, when it comes to non-life insurers, clearly there is an expectation that they should be eligible for PAA, and this has been clearly articulated in their disclosures. The impact on equity for non-life are not significant, mainly because of the PAA, which follows similar model on premium. Although there would be impact if they have to follow GMM for their insurance contracts. Also, what we have seen is where elections are possible, general insurers have elected for insurance acquisition cash flow to be charged directly in P&L as they are incurred. General insurers have also tried to not apply discounting for their short-term claims. Also, we have seen trend for general insurers where they are using, I would say, a bottom-up approach as compared to life, where they tend to use more top-down for their life and annuity business. In terms of risk adjustment, the intention for general insurers has been to apply confidence level technique, and some of them have provided a broad indication of what their confidence level may be under IFRS 17. Now, let me move on to KPIs. So KPIs for non-life, there is not significant change, although so they would we expect they are continuing to use gross written premium. Now, gross written premium, although is not going to be get measured this time, right? Because you would have insurance revenue, and there is a possibility, or I would say potential for companies to show insurance revenue as per IFRS 17 as a top line growth measure in the future. Combined ratio, again, is something that we expect the general insurers would continue to report, although I would say that in terms of trend, the denominator for combined ratio is very clear, that and consensus there where they would use insurance revenue as per IFRS 17. The numerator is this various approach in terms of using numerator, where some companies would like to follow insurance service expenses only as per IFRS 17. Some want to adjust that amount to also include direct attributable expenses, and some are going even beyond, and they want to show adjustments for reinsurance net results. So we are seeing this varied approach, but we are hoping that these disclosures are made clearly in the account, so one can see how the combined ratio can be compared between two companies, for example. So not varied, we're not saying varied change in terms of KPIs under IFRS 17. Now, what comes next for general insurance? Clearly, lots to be done. If you look at the opening, the comparative financial statements, they would want to know when they want to publish them. Do they want to accelerate it? When they look at the first full IFRS 17 accounts, there's lots still to be done. General insurers would have to reconsider their finance and actuarial team, whether they have enough capability, capacity, enough time to produce their accounts, because there's lots to be worked upon and disclosed. Not to forget auditors. They have to manage auditors. Auditors are very keen to understand the governance over the processes and controls for defining these numbers and how these are being covered. And then comes the stakeholders, because stakeholders, board members, audit committee members, they would want more insights. They would want to know what key adjustments, key estimates have been made, what challenges management have addressed or applied while doing the calculation of IFRS 17. So finally, I would say the journey of IFRS 17 implementation has been mostly roller coaster for life insurer as well as for some general insurers. The end of the tunnel is yet to come, and there's lots yet to be covered. And it's important to plan in advance and to make sure that we are really fitting the timeline as well as doing the quality work on IFRS 17. And we're seeing the rigor, as I mentioned earlier, for the smaller insurers now to get ready for preparing IFRS 17. Now, I will now pass on to Nicola. Next.
Brill, thank you, Geeta, and apologies if anyone had any sort of sound issues there. We'll sort of try to sort of make sure we highlight the key points from that when we send round the pack after this webinar. But anyway, just in this section, so I'm going to talk through some key areas on the FCA's agenda. So I'm going to firstly provide an overview of some of the key aspects from the recently published FCA's business plan, as well as areas from the regulatory initiatives grid. I'm then going to provide an update on progress firms should be making on the FCA's consumer duty of care. And finally, I'll touch on a few hot topics, including the appointed representatives regime and the recently published guidance on how insurance firms can support customers in financial difficulty. So firstly, the FCA's business plan. So this year's business plan builds on last year's publication as a continuation of the FCA's 3-year strategy. There are some updates to reflect the government's legislative agenda and changing economic environment, and there's a focus on the impact for consumers in financial difficulty. And the key themes for the 3-year strategy are and remain as set out here on the left-hand side. So reducing and preventing serious harm, setting and testing higher standards, and promoting competition and positive change. And under each of those 3 themes set out within the business plan, the FCA has described a total of 13 commitments, and they've highlighted 4 of these as being the greatest priority for this coming year ahead, and they're sort of set out on the right hand side here. So those being preparing financial services for the future. So the FCA will work with the Treasury to implement the new regulatory framework to address emerging harms more efficiently, putting consumers' needs first. So this is about improving consumer protection and standards for all consumers and ensuring support for struggling consumers. So that remains a priority for the FCA. Reducing and preventing financial crime. So prioritising this aims to help protect consumers, including those with vulnerable circumstances specifically, as they may be more susceptible to things like fraud. And strengthening the UK's position in global wholesale markets. And that's to help ensure that the UK continues to be seen as one of the leading global markets of choice. On the next slide, so we've just set out a few takeaways in relation to the business plan. So, we can expect to see the FCA setting and testing higher standards. An important thread is the FCA's flagship consumer duty regulation, which I sort of touch on a bit more detail a little later. And the FCA's budget allows 5.3 million for successful embedding of this over the next year, with more staff focused on how the regime is operating in practice and sort of taking firms to task where weaknesses are identified. The current economic environment provides really important context, and the business plan notes more focus on customers in financial difficulty, vulnerable customers, and also the cost of living crisis, which I know we sort of touched on. So a sort of key theme which carries on. And then there's other areas of focus. So kind of in terms of topics, it's clear that there'll be further review on whether firms are remaining within impact tolerances under the operational resilience rules. There's a clear focus on firms' financial resilience. The FCA will further focus on fraud prevention, so using a combination of consumer awareness measures, use of intelligence, and also making sure that swift action is taken to combat fraud. And to support the UK becoming a net zero financial centre, the FCA's ESG focus includes addressing misleading disclosures and promotional materials, and they continue to work on sustainability disclosure. And the plan also focuses on embedding the new appointed representatives regime, which is another topic that I'll pick up on later. And unsurprisingly, there is a hefty sort of policy focus following on from the government's Edinburgh reforms agenda, with a budget of 12 million for the year ahead. And I think the increased resources for enforcement indicate that the FCA will take swift action where high risk activity threatens either the integrity of the financial system or indeed consumer protection. And I was just going to touch on the Financial Services Regulatory Initiatives Grid, which is produced by the Financial Services Regulatory Initiatives Forum, and they published their last edition at the end of February this year. And this sets out the regulatory pipeline, and it's slightly different to the business plan in that it covers all regulators and gives expected timeframes for publications and consultations. And it's really there to support the FS industry plan for initiatives that may impact on them over a 24-month horizon. And actually, a document itself, it's quite user-friendly, it's interactive. There's an Excel version, and you can cut it by regulator and sector. So across that document, it covers about 150 initiatives. And I guess just a few sort of comments on that document. We've seen a small increase in the total number of initiatives since the last grid, which was in May last year, but the overall pipelines remain broadly stable, and a number of the changes that we have seen actually reflect those policy-driven changes, which ultimately should have the intention of reducing the burden on firms by simplifying and improving the regulatory framework. And again, a number of common sort of initiatives which I've touched on in line with the business plan, so operational resilience, ESG, and conduct continues to be a prominent feature with the backdrop of cost of living crisis and the incoming consumer duty requirements. And I'll touch on both of those next. So I appreciate perhaps there's been a little sort of consumer duty webinar fatigue. So in this session, I focus on what in-scope firms should be prioritising now and how you can put in place appropriate governance and oversight procedures. So in terms of what firms should be doing now, so firms should be well underway with implementation. There was a requirement to have completed implementation plans by October last year, and the July deadline for this year is fast approaching. But we've seen the sort of rhetoric change a little bit, and I think there's clear recognition that the timeframes have been very challenging, particularly to allow that sort of full strategic response where technology changes may be required. And the recent sort of FCA comms have referenced substantive compliance. So I think important to sort of keep following those sort of comms and communications and responding accordingly. And one thing I just wanted to pull out here is the FCA published findings from their multi-firm review on consumer duty implementation plans at the end of January this year. And they actually provide a good steer on the FCA's expectations on what firms should be prioritising to help them demonstrate engagement with the duty and compliance with the requirements. So key areas for attention, so effective prioritisation, ensure there's a clear business case for prioritising some areas of implementation ahead of others. Does your response evidence that you've addressed the biggest gaps and areas of sort of most harm or risk? This may mean that plans need to be reprioritised in flight or resources diverted. And I think there's recognition that not everything might be fully in place from day one. So some aspects may be iterative, or enhancements may be made with things like technology after implementation. So sort of, telling that story is really important. Embedding the substantive requirements. So again, making sure you can evidence that you've considered the requirements and that you've taken action which are appropriate actions, but being clear about when those actions will be complete. And the consumer duty requirements shouldn't just be considered superficially. Firms should challenge what their existing arrangements are and not be overconfident in what they'll deliver without sort of testing those and getting some assurance over those. Then working with other firms, so ensure there's clear understanding and a timetable of engagements that's required with third parties, so such as firms in the distribution chain, and where firms outsource the delivery of services to other parties, and that's both in the run-up to implementation as well as on an ongoing basis. Then we touch on deliverability. So ensure timelines and resources are reasonable, and that risks and dependencies have been sufficiently identified and mitigations clarified. So, these areas should be reviewed and challenged throughout the governance process to ensure the firm's plans are set for success and are being delivered as expected. And as the run-up to implementation, this will be kind of increasingly important. And finally, I just wanted to mention that the FCA also provided feedback on firms' fair value assessment frameworks earlier this month. So firms should ensure that the feedback, such as, making sure you're monitoring fair value, ensuring assessments are presented clearly, that they're well governed, that you're ensuring distribution of outcomes are assessed kind of more broadly, making sure you've considered those kind of key findings, and again, updating your frameworks to reflect on any feedback received. And linked to that, so firms should also make sure that you've considered other publications, so important things like the FCA's Dear CEO portfolio letters on the consumer duty. So my steer is to really think about, your story as a firm, so that you've got a clear articulation of how the consumer duty applies to you, the gap and the delta of where you are and where you need to be compliant with the duty, and actions that are being delivered to address those gaps. And, as part of that, the governance framework is really important, and making sure you've got appropriate board engagement, which leads me on to my next slide, which I'll sort of touch on very briefly. So we kind of just set out some key pillars here around governance and oversight. And again, this is during implementation period as well as beyond. But in terms of, taking each of these by turn, so the FCA said senior managers and boards are accountable for delivering good outcomes. They want to see senior leaders in firms driving the changes needed and making sure that the standards are being met. Consumer duty champion appointment. So firms should also have appointed a consumer duty champion who ensures the duty is discussed and raised and challenged at a senior level, and that the importance of the duty is recognised. And again, making sure that you've got a framework in place which allows you to evidence decision making and agreement of actions, as well as making sure that you're also considering customer outcomes. How will these be measured, monitored and reported on, in turn to support that annual confirmation of compliance that the firm's meeting the requirements. And that's really driving a focus on enhancement to customer outcomes testing and MI and reporting. So as we move to that implementation timeline, so firms are really thinking about their evidence book in terms of compliance with the duty. So again, second and third line play an important role here to provide their assessments of key risks or effectiveness of controls and assurance around implementation. And again, to make sure that customer outcomes are being considered on an ongoing basis. And I think without a doubt, making sure you've got a customer-centric culture in place is really important, and therefore people and training approach and consideration of the firm's strategy and leadership more broadly is going to be really important for success. Right, and just I've got a last kind of couple of slides, which are really sort of more of a takeaway, but appointed representatives. The updated appointed representatives rules and guidance came into force in December last year, and these seek to improve principals' oversight of their ARs and increase the information principals provide to the FCA and raise standards. So the FCA want to see stronger oversight by principals to reduce harm caused through ARs, as they don't want to see principals, they don't always see principals adequately doing that onboarding and the oversight, particularly on an ongoing basis. So in light of that, increased expectations and requirements such as notification around new and existing ARs to the FCA, increased reporting, clearer expectations around that onboarding, monitoring and offboarding of ARs. So again, I think we'll expect to see the FCA looking to test this with firms to make sure they've appropriately embedded these rules. And so we might see the FCA sort of increased engagement on this topic and increased scrutiny as part of their ongoing supervision, particularly leveraging some improved data. And then last slide, so just touching on this, the FCA issued a consultation paper, which was insurance guidance for the support of customers in financial difficulty, which was issued in Jan 23, so earlier this year, aimed at insurers and intermediaries. So the updates, this updates the equivalent and previously issued finalised guidance that we had in relation to COVID, but is obviously broader in scope and covers all customers in financial difficulty, regardless of the reason for being so. And it aims to deliver good outcomes for customers in financial difficulty, particularly by helping those customers to make insurance that they can afford. So they don't want firms just to be cancelling insurance policies solely because of non-payment without first considering actions to support customers who might be in difficulty. And the guidance sets out what firms should be doing. Some examples: make customers aware of and the help that is available to them if they are experiencing financial difficulty, being aware of the indicators that might indicate someone's in financial difficulty, so missed payments, customers not renewing key insurance, customers, having conversations about it, and firms should also consider appropriate actions. So they call out a number of aspects such as reassessing customer risk profiles, considering other products, adjusting covers, and working with customers to avoid the need to cancel covers. And if that's introduced, the FCA intend to bring it in end of July, so aligning to the Consumer Duty framework timelines. So a lot to navigate there, but being engaged on these matters and thinking about key risks and priorities for your business will be really beneficial and position you well. So next, I'm going to hand over to Thomas Toe.
Hi, good morning, everyone. I'm Thomas Toe, Insurance Tax Partner at BDO. For this part of the webinar, we will cover some of the recent corporation tax changes, followed by a reminder of the upcoming employment tax filing deadlines, and finishing with changes to the R&D tax relief regime, which could benefit insurers. Next slide, please. So you may have seen the recent spring statement by the Chancellor of the Exchequer, Jeremy Hunt. It was boring. Yes, it was boring, but deliberately so, especially after the catastrophic mini budget of Kwarteng and Truss. It was aimed to stabilise, and I think it has. It was very much focused on bringing people back into the workforce, growth and investment. As you'll see, that's why they've actually brought in this full expensing regime, which will allow companies to deduct 100% of the cost of qualifying plant and machinery for the trade in the first year, although the special rate additions will qualify for 50% in the first year. So this full expensing regime effectively replaces the super deduction regime from April of this year. And additionally, the annual investment allowance of £1 million was due to be reduced, but it has been kept at £1 million and it can be used alongside the full expensing that I've just talked about. So this has no doubt been brought in to soften the blow of the increase of the main rate of corporation tax from 19% to 25% from April this year. And this new higher rate will apply to companies with more than £250,000 of taxable profit. I suppose there is some good news. The good news is that for companies with less than £50,000 of taxable profit, you'll still be taxed at 19%. And in between those two thresholds, there'll be tapering of the tax rate. Making tax digital for corporation tax is still coming, but not before 2026, although I've heard murmurings that actually might even be later than that. So moving on to international tax matters. So the OECD Pillar 2 initiative proposes a global minimum tax rate of 15%, and it's aimed at the largest businesses with a globally consolidated revenues of more than 750 million euros. Draft UK tax legislation has been issued, but they are complex. They're very, very heavy read. And I know the trade bodies such as the ABI, the AFM have, and they do continue to seek various clarifications from HMRC. One example being the application of the rules to mutuals, who are typically not taxed on their underwriting business, but maybe taxed on their investment income, gains, less expenses. So something to look out for. IFRS 17, I know some of my colleagues have touched upon IFRS 17. The IFRS 17 tax regulations have now been enacted. The main consideration is how the transitional adjustment is taxed. Now, following several months of consultation, the life assurers will be taxed on the transitional adjustment over a period of 10 years, whereas the general insurers will be taxed in one go. So the government took the view that most general insurers should not have significant transitional adjustments, and hence they will be taxed in the first year of transition. And in the future, the tax will continue to follow the account, so no changes there really in terms of the methodology. But we have seen complications already where you have a business transfer between two companies reporting in different gaps, UK GAAP to IFRS, for example. So that's something we really do need to consider with care. I won't talk too much about R&D tax reliefs. There have been some very good changes actually coming in. Not least you've heard from my colleagues talking about technology, actuarial modeling changes and the like. So Ravi will talk about the R&D changes, and opportunities for businesses. Next slide, please. So I won't say too much on this excitingly named Tax Administration and Maintenance Day, except that the government are looking to simplify regimes such as diverted profits tax, transfer pricing, and permanent establishment, which are very much relevant for large multinational insurance groups. They want to make the law simpler and clearer, but I'll be honest, whether they'll achieve that aim remains to be seen. So at this point, I'll hand over to Claire Murray, who will cover the upcoming employment tax filing deadlines.
Thank you, Thomas. Yes, there was little that really exciting that happened in the budget in the world of employment tax. I thought instead, given the timing of this webinar, that I just touch on the forthcoming reporting requirements for employers. Because in the world of employment taxes, the spring and the new tax year isn't really about looking forward, it's actually about looking back and thinking about what's happened and then what needs to be reported. I'm not proposing to touch on any of these in any particular detail. They're all kind of quite big topics of their own, but I guess across all of them, there's a general theme around, start as early as you can with all of the reporting requirements. They can be quite complex. It's not least because often in the world of employment taxes, there are quite a few teams that may be involved in the data, sort of holding the data or needed to help with the filing. So that might be across payroll, finance, tax, HR. And as a consequence, that's why things sometimes can go awry, because things can fall between two stools where somebody thought that somebody else was maintaining records and so forth. So would always urge to start early, and also as part of the process for collecting the necessary information for 2022-23 reporting, actually take time to reflect on what actually has gone well and what improvements could be made for kind of the year ahead, because actually now is the time at the beginning of the tax year to think about what process and controls could be improved if you think that is the case. And the other thing is just to say that obviously the additional complexity can be sometimes if there's been any kind of corporate changes, whether that's people moving around, business acquisitions and so forth, and then thinking about what that means from an employment tax reporting perspective and who actually needs to report what for whom. So the first deadline that's upcoming, it's actually only next week. So if you aren't aware of it or need to do something and haven't, then there's a little bit of time, but not long. So that's around short-term business visitors. And I think common misconception is that either people coming in temporarily to the UK, there's no pay-as-you-earn requirement. Well, there is from day one, probably, unless an agreement has been reached with HMRC. But I think the other common misconception is that once there is a short-term business visitor agreement in place to sort of apply that reporting relaxation, is that it applies more widely than it actually does. There are certain individuals that would never be covered by it, those from non-double tax treaty countries, non-resident directors, branch employees. So other kinds of reporting might be required, whether that's some kind of special annual payroll or even the main payroll. So again, it's sort of not an assumption that once there is this agreement in place that it's a question that everybody is covered by it. The next deadlines that fall after that are around this is the P11D reporting deadline on the 6th of July, and I think that this is the first year actually where paper forms aren't permitted. So hopefully everybody knows that. If not, there's some time to either find someone that can help you with filing them electronically, or time to work out how to file them yourself through the government gateway. There is actually sort of electronic means that HMRC have provided. I think the other thing that we're finding, or we have been finding over the last few years, is where sort of post-COVID, sometimes benefit patterns, expense provisions changed in light of different working patterns. And it's about making sure that the tax consequences of anything new or that's a bit different is understood. And again, there were some reporting reliefs available during the kind of COVID pandemic, which have now fallen away. So it's just been very clear what does and doesn't need to be reported. And actually also, are they things which had already been subject to pay-as-you-earn through the payroll? And the final point to note on obviously on the P11Ds is, even if benefits are payrolled, Class 1A national insurance still does need to be paid on those benefits, and that's by reporting on the P11DB form, which is sort of the sort of summary page, but that's how any payroll benefits need to be picked up. Also on the 6th of July, I guess relevant to PLMDs and then touching on into the PSA is the fact that actually this is also the deadline for if changes need to be made to the pay-as-you-earn settlement agreement scope. That's the deadline to do it. So it needs to be done before the P11Ds are submitted. So as part of that process, are there things you don't want to put on P11Ds, but actually do need to be taxed, and you'd actually quite like them to go into the pay-as-you-earn settlement agreement? So again, early consideration means that the PSA scope can be updated at the same time. Appreciate that employment-related securities won't be relevant to all on the webinar this morning, but just on that, it's a question of noting that there are some more mandatory fields that need to be completed this year if you are doing a filing, making sure you know what does need to be reported and who's reporting it, particularly if there's sort of multiple entities in a group, and it's not just formal plans. The other thing I would also urge is early consideration of that form, because if there, as part of the reporting process, you identify that there is some employment-related securities in which PAYE should have been operated, unless that is collected from employees by the 6th of July, further nasty tax charges can arise. So it's good to think about it as soon as possible, so that actually can also be managed. And then finally, and certainly not least, is the PSA reporting requirement. I put 31st July. That's actually not a statutory deadline. It's the date which HMRC put on the agreements in pretty much all cases these days. Actually, it's the payment deadline of October, by which the return absolutely must be submitted. But clearly, I would always encourage people to prepare and submit as soon as possible. And really, it is a question, as I mentioned, in the context of P11Ds, of just reflecting on any new benefits that have been provided, what needs to be captured, and what exemptions and reliefs apply. Do you actually understand them? What the true kind of scope of them? Sometimes exemptions are narrower than people think they are. And is there anything that's sort of new or different that needs to be captured in the 2022-23 return? And with that, I'm going to hand over to Ravi, who's going to cover R&D tax credits.
Thank you, Claire. Hi, I'm Ravi. I'm Associate Director in R&D Tax in the FX department. I'm BTech in Computer Science, and I've had 8 years experience working in ABN AMRO Bank, developing their distributed credit risk calculator systems. I have 7 years experience in helping companies make R&D tax relief claims in FS. And in the next 5 minutes, I'll be talking about large-scale changes that have come since 1st of April 2023. And I'll echo Thomas that there are a lot of good news in the update. However, HMRC wants clients to take good care and due diligence for their claims going forward. So what are the changes? First and foremost, the rate change of RDEC has been announced. Since 1st of April 23, the rate has gone from 13% to 20% of RDEC subsidy, which means a net of 15% being received over the line as a pre-tax tax earning. For companies which are SMEs, which fall below the large company thresholds, the subsidy is 18.6%. Companies which spend more than 40% of their R&D spend, of the overall spend in their R&D, will be qualifying at a higher rate and will receive a subsidy of 26.97%. From what we know, that the announcement suggests that more projects will qualify than previously did, or we think, such as development of systems that leverage big data, projects like person matching, network infrastructure for large complex algorithms, advisory analytics, or regulatory and compliance reporting. Santiago earlier touched on a few of the projects on actuarial analytics and insights, use of NLP and RPA for underwriting and identification management. Those kind of projects will also meet the new guidance and likely or potentially qualify on the investments. Some of the projects that could qualify is your legacy systems, where you appreciate improving it from its existing state, such as the systems which you use for insurance quotations and sales platforms. So what changes from 1st of April 23? The R&D definition has been extended to include pure maths, which means the actuary spend where there's a lot of mathematical modeling which underpins the research and development in that area will also be qualifying for our purposes. Other than that, overseas costs, the window for including overseas costs where the projects are directed from UK and recharged to the UK entity in the overseas jurisdictions are allowed until 1st of April 2024. So the window has been extended from 1st of April 23, which was previously proposed, but the window has been extended. So it's a positive news. From April 24, there will still be exemptions for overseas staff to be permitted for inclusion in the claim, permitted for geographical, environmental, and social or regulatory requirements. There's a big focus from HMRC to prevent fraud and misuse of the R&D regime. So they have hired 200 or more R&D specialists on reviewing the R&D claims. So it's important that the claims that are put through are of good quality and detailed descriptions. From the 1st of August 2023, that is this year, later on, additional information form will be required. This is digitization of R&D claim submission. And the details of the person who, from the company who is making the claim, will have to assume responsibility of the claim, and the R&D advisor's name and contact details will also have to be provided. So it is quite clear that HMRC wants the R&D space to be more regulated. There's some more updates on pre-notification requirements, but mainly what it says is if the company hasn't made the claims before, in the past, they'll have to pre-notify. However, there are other sub-guidances that is too much to go in detail in this session, but I'll happy to respond later on if you have questions and would like to get more details. And finally, I'd like to state that BDO has a R&D benchmarking tool that can compare your R&D claims that you've made in the past with your peers, similar sized clients, just to get a idea of how much spend yours compared to your peers in the industry. With that, I pass on the mic to Graham.
Thank you very much, Ravi. And with that, we're at the top of the hour. It's been a massively packed agenda, and I don't think I remember a time when there was so much, non-discretionary change coming in on our industry. So thank you to all of the panelists for their content, their thoughts, and of course, for those of you listening to the recording later, we're always very happy for you to reach out to us and catch up on some of the questions that you would have asked were you live. For those of you who did ask questions throughout, we've addressed those during the session. So in the interest of time, I don't suggest we ask any more questions to the panelists at this stage. Thank you very much for your attention and look forward to seeing you on future webinars. Bye now.